Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 281 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. Matt is traveling again for business this week, so I'm joined by Nick Whitaker for the second week in a row for today's episode. So, Nick, thanks for hopping back in with us today.
Always good to be here. 2 in a row. Got 2 under the belt, which is nice.
Got a streak going.
Yeah.
As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from Y-Charts and as of the market close on December 18th. S&P 500 index down 2.7% for the month and up 23% for the year. The Dow Jones Industrial Average down 5.8% for the month and up 12.3% for the year. The Nasdaq Composite Index up 0.9% for the month and up 29% for the year. The Russell 2000 Small Cap Index down 8.7% for the month and up 10% on the year. And the Vanguard All World United States ETF down 2.9% for the month and up 3.6% for the year. 3-month Treasury rate at 4.36%, the 2-year Treasury rate at 4.35%, and the 10-year Treasury rate at 4.5%. Moving on to big headlines, current events from this week. Nick, obviously the big one being the Fed met yesterday, which was Wednesday of this week on December 18th. And the Fed lowered interest rates again by 25 basis points or 0.25%. From a target range of 4.5% to 4.75%, down to a range of 4.25% to 4.5%. So Fed officials said that they expect fewer rate cuts next year, with most of them penciling in 2 cuts for 2025 if the economy continues to grow steadily and inflation stays under control. But this was not great news for stocks yesterday. So this kind of sent stocks into a free fall yesterday afternoon, with many of the indices down anywhere between 2 to 4%. So it was definitely an interesting reaction. Volatility came back very quickly into the market after it has been virtually non-existent for the past several weeks or month and a half or so. And one interesting thing that I saw last night, Nick, this was a tweet from Jason Gopfert on, again, yesterday, the 18th of December. And Jenna will show this on the YouTube page, and this will also be in our show notes. But he said every time the VIX jumped by 50% in a single session, it plunged over the next month, every single time. Is this going to be different? Seems like it could be, but we all know the danger of the phrase, "this time is different." And what this shows is each time the VIX, or the volatility index, also known as the fear gauge in the market, usually when the VIX is higher, stocks are lower, and vice versa, it shows all the instances going back to 1991 where the volatility index has increased by 50% or more in a single trading day. And yesterday, I think the VIX was up something like 74%, I think, at the end of the day. And what it shows that, a month later, the VIX has been lower every single time, which means stocks recover at least a little bit after some big volatility events like this. So I don't think it's time to sound the alarms just yet. It is just one trading day, even though it was a very weak trading day. I guess investors were a little bit spooked of the idea of the Fed only lowering a couple of times next year. But as we know, that opinion of the Fed can change very quickly. And I would actually be shocked if it was actually only 2 rate cuts next year because, predictions change from time to time and they're very data dependent, where we could get weaker economic data sometime in 2025, which could force their hand to lower rates even further. So do you want to add anything to this or have a take on the Fed meeting yesterday?
Yeah, I think the one thing I'll add is that the commentary from Powell, I think, is what particularly spooked the market, because the market was expecting, like you mentioned, a few more rate cuts next year. And so, you see this big reaction, which I think is a normal reaction, especially given the gains this year. I mean, even with that, let's call it a 3% pullback. If you look at indices year to date, all still very good numbers, very strong, very healthy. So you're just having this readjustment to Powell coming out and saying, listen, we're going to wait till the new administration comes in. We're going to see how things shake out. We want to make sure inflation continues to move lower. And then the dot plot kind of opened the doors for a little bit of ambiguity. And as we all know, the market doesn't love ambiguity, which is why you have that volatility spike and the pullback. This is normal. I think this makes sense. It's not fun to watch. No one loves it, but it's just a bit of a repricing, a little profit taking, and big picture. The market's still doing very well this year. If you would have, we say this all the time. If you close your eyes on 1/1 and open them now and said you're up 23%, you say, okay, yeah, I'm okay with that.
Good year,
Yeah,
right?
yeah.
And you kind of forget all of the day events like we had yesterday. So
exactly.
Definitely something to keep an eye on, but markets were slightly higher this morning the last time I checked. So we will wait to see what the rest of the month brings us. Moving on to tweets, articles, and research from this week. The first thing I had was an article written on Schaefer's investment research titled "What the Latest Dow Shakeup Could Mean," and this was by Rocky White back on November 5th. So this article talks about the performance of stocks that are added to the Dow Jones Industrial Average and the performance of stocks that are removed from the Dow. So back in November, NVIDIA and Sherwin-Williams replaced Intel and Dow Holdings Inc. in the index. And yes, there is a company named Dow that was in the Dow Jones Industrial Average. They're a materials name, and they specialize in commodity chemicals. But what Rocky found was that since 1997, there have been 26 stocks that have been added to the Dow. And these stocks that were added averaged an 8% return over the first 3 months after being added to the index, with 65% of the returns being positive. However, a year after the additions, those same stocks were up just 1.74% on average, with less than half of the returns being positive. And on the flip side to that, since 1997, there have been 18 stocks that are still in business today that have been removed from the Dow. So roughly 8 stocks that were removed from the Dow that are no longer in business or no longer publicly traded. And those 18 stocks Rocky has data for have performed terribly, especially immediately after leaving the index. These stocks have averaged over an 8% loss over the next month of trading after leaving the index, with only 17% of the stocks having positive returns. And the 6-month returns also underperformed by a lot, averaging a loss of 2.7%. with 33% of the stocks having positive returns. So just thought that it was interesting. Typically what you would expect is maybe strength from stocks that are getting added to the index, because mutual funds and ETFs have to buy up a certain amount of these names to be able to track the index. But I was pretty surprised by this data. And I guess not necessarily too surprised that stocks leaving the Dow tended to underperform significantly. So I guess we'll wait and see how Intel and Dow Inc. perform. But Intel, for example, has been very weak relative to the market over the past really 10 years, especially if you compare the returns of Intel to a bunch of the other semiconductor names that have been performing really well. So thought this was interesting with Dow shakeups. I think in the past, I'm talking about 10, 15, maybe 20 years ago, people maybe could have had an edge with these names getting added and removed from the index based on buying those names or shorting those names. But I think it's this data is now well known and kind of out there for everybody. So I'm not sure there's much of an edge there anymore.
Yeah, I'd agree with that. I think it more tells the story of what's going on with these companies, and we talk about it all the time with companies and the story in the stock, right? I think we talked about that last week. And when you have a company or stock that's being dropped from an indice, that's a bit of a signal to the market that this company, most of the time they're mature companies, they're in the back half of their lifetime. Companies don't go on in perpetuity, as we know. I forget the exact average on it, but companies aren't around for a couple hundred years. That's just not how that works. Right. Unfortunately, or maybe fortunately, who knows? So when you see that happen, it makes sense. And I've personally watched it happen with companies that I worked with at my previous role on the institutional consulting side, when I saw these companies get dropped from the indices, and you see the shareholder turnover and what happens. And the passive guys, the indexes that your Vanguard, your BlackRock, your State Street that have to buy these guys. Well, obviously they're dropping shares, so now you kind of flood the market, you flood the float
with supply.
And yeah, exactly, you're flooding supply, and the people that are out there are saying, well, we need a really good price to buy. Not to mention you have the short sellers that come in on top of it, so it just kind of makes for a recipe of underperformance. And if anything, range bound. And when we talk about that, we talk about a stock that's just kind of bouncing back and forth between these ranges, whatever they may be. So you'll see those types of narratives take place oftentimes when you have names leaving in the industry, but particularly when they're dropped from like the big ones, your S&P, even if it's like S&P 400 or 600, or the Dow or the Nasdaq. If you're getting dropped from an industry, you're going to see a lot of that turnover, and it makes sense, but it's part of it. That's part of capitalism,
our industry, and how markets work, right?
Yeah.
So the second thing I had was an article written by Jason Zweig in the Wall Street Journal, and this was back in September, on September 20th, and it was titled "Solving the Mystery of Investment That's Too Good to Be True." So I think we've talked on here before, Nick, about investments or opportunities for investments that we would look at and kind of scratch our head and say, hey, this just doesn't seem right. But for people that may not be in our industry or don't have a lot of experience with investing, these things can catch people off guard. And a lot of the times there's things like this that I'm going to talk about that are fraudulent. And yes, they turned out that it was too good to be true. So I just wanted to highlight one of these, fraudulent investments that Jason took a deep dive on. So I just want to read a few pieces from this article. So he says, in a column published on August 30th, Jason highlighted a peculiar investment called the Mega High Yield Term Deposit, which claimed to offer up to 15% guaranteed annual return for 10 years. So he dug in to see if the investment could possibly make sense at all, and obviously it didn't. And what he learned in the ensuing weeks is even crazier. So it's a tale of non-existent companies and unlicensed salespeople making absurd claims. YieldWealthManagement.com was still promoting colossal yields, quote unquote, without the risk, with, quote, fully insured guaranteed returns of up to 17.1%. The site claims to be for Yield Wealth Management, LLC, an SEC-regulated wealth management firm, but the Securities and Exchange Commission's public database of registered investment advisory firms has no listing for Yield Wealth Management, LLC, which obviously is the first red flag, right? But people aren't saying, if they say that on their website they're registered with the SEC, then they have to be registered with the SEC, right? There's not a lot of people out there digging in and going through SEC filings to make sure that is the case.
I've dug through plenty of SEC filings in my day. It's not fun.
Right, and it's time consuming. So in addition, one salesman shared verbiage he would send to people to market these products, and Jason got his hands on this. And one of those lines in an email that he would send was 10-year, 10.5% compounding interest for a total of 2.7x. If you leave the interest in for the full term, fully insured for principal and interest up to $10 million per account. So most of the nearly 24 people Jason identified from the sales leaderboard didn't have securities licenses, which obviously red flag number 2. He said one insurance agent told me he earned commissions between 9% and 12% on these products, and that some agents may have earned all the way up to 21% commission on these products. So it's really sad that this stuff still goes on today, but that's one of the reasons why, the term guaranteed return is virtually non-existent in our industry, because nothing is guaranteed. But when you're someone that, maybe is retired and you're very conservative and you don't want to deal with the stock market, and you see something like this pop up, a 20% guaranteed return for the next 10 years, you get really excited, right? And there were instances where people unfortunately fell for this and lost everything that they had, which kind of it dovetails into my next item, which was about a blog post from Ben Carlson titled "The 4 Types of Investment Mistakes." Ben talks about specifically this fraudulent investment that went on, which I'll get into here in a little bit. But what are your thoughts? I know that, this type of stuff has definitely not happened as often as it did 10, 15, 20 years ago, which is a good thing. But sadly, it still does happen.
Yeah, the major fraud stories over the past 10 years have declined, I'd say aggressively. There's normally 1 or 2 that come out, but most of the time they're coming out with like really, really big high net worth individuals that are putting a lot of money in hedge funds, and then there's some fraudulent things that go on at the hedge funds. What was his name? The guy at with the Credit Suisse, Bill Huang. Is that right?
Oh yeah, that happened a couple of years ago.
That happened that's the last one that I can think of. That was really big. That kind of shocked the system, and that just turned out to be some kind of fraudulent, gross misrepresentation of risk, right? Across multiple areas, the bank, the hedge fund, misrepresentation to the investors, all of that stuff. So it's happening less and less, but like you said, it's still out there, which is why, don't put all your eggs in one basket. Diversification is a very important thing. And the other thing that jumps out to me, anytime someone comes to you and says the word guarantee,
run the other way.
Just take a real deep breath and probably take a couple steps back, because there's, like you said, there's no such thing as a guarantee in investing and most things in life. And even we've all lived this with our personal lives, with insurance and home warranties and all kinds of things, and the guarantee. I'm not sure about that so much. So when you hear guarantee, pause.
Yeah, pause and make sure you do your research, because this type of stuff unfortunately is still out there. So like I said, it kind of goes nicely into my next item, which was a blog post from Ben Carlson talking about the 4 types of investment mistakes. So he said the first is annoying mistakes. So these are the investment mistakes that could cause regret but don't necessarily wreck your plan. Examples of these are selling a winning position too early, holding on to a loser for too long, not rebalancing your portfolio, or investing in an underperforming fund. Second type of mistake is self-inflicted mistake. So paying high fees, trying to copycat billionaire investors, over trading, not doing your due diligence on an investment, confusing your time horizon with someone else's, assuming you're smarter than the market, etc., which we've talked about those self-inflicted mistakes a lot on this show. And the third is painful mistakes. So these mistakes will cost you some coin, cause serious regret, and leave lasting scars. And the timing, the markets is a big one here. So he says making a terrible mistake at the worst possible moment, such as selling out of your stocks after they have already gone down a healthy amount, or missing out on a raging bull market by sitting on the sidelines. You can survive painful mistakes, but they can also cause long-lasting damage. And last but not least, endgame mistakes. So he says these are more or less impossible to come back from. These include fraud, scams, Ponzi schemes, losing all your money, etc. And he actually talked about the article that Jason wrote in the Wall Street Journal that I just discussed, that people unfortunately did not recover from. So he said the guy that invested in these colossal yield or mega high yield products heard about a firm called Yield Wealth and the guaranteed 15.25% return it was offering to investors on some products. He says, quote, "I figured this is an amazing opportunity and I'll be set for life." And he talked about it so obsessively. His wife said that despite her misgivings, she eventually told him, quote, "It's your money. I have no clue. I don't care anymore. Do what you got to do." So in March, this gentleman withdrew his entire 401k from Fidelity, which was about $763,000, and rolled it over into an IRA with Yield, which was affiliated with a firm called Next Level Holdings. In early November, Next Level failed to send out monthly distributions to investors. Then on November 15th, Next Level sent clients a notice that the firm would be liquidating investments and winding up its affairs. So this gentleman and other clients were given no indication of when or if they would be cashed out or how much they could expect to receive. So, as much as people want to think that it's like impossible for this stuff to happen, I can assure you that it's not, and it does. And we, again, just this fall, this happened with this gentleman rolling over his 401k into an IRA with this firm, Next Level Holdings. Turned out that it was too good to be true. So I think it's just really important to do your due diligence on this, or run investment ideas by a friend or by a professional, especially if you have a contact of a person who is in the financial advisory industry. Never a bad idea to just shoot them an email or give them a call and say, hey, I heard about this product. Can you take a deeper dive, or do you know anything about it so you can share it with me? I think that would help, alleviate these types of things happening in the future. Because again, this is just a really sad story, and one of those endgame mistakes that virtually, I think this gentleman was 60 years old. It's almost impossible to recover from when you're 60, right?
Yeah, that is absolutely. Yeah, that's tragic for that individual.
So, but hopefully Nick has some more positive items to share to lift the spirits a little bit. So,
yes.
So Nick, I'll turn it over to you.
The first thing I wanted to do is just share a quick review of sector performance year to date. I know we do the big picture, but just kind of peel the onion a little bit, just for listeners, just so they're aware of kind of what's going on. So I just took a screenshot of internal data. We pull the data from Y charts, just so people could see the breakdown. You can see a little bit of the U.S. market caps. So the S&P 100, which is your mega cap names, are leading the way a little bit this year. The international equities are doing okay, but keep in mind that 16% is counting the U.S. So that's what the difference is between that 16% and the VEU that we quote at the beginning of the show. Pretty big difference.
Yeah.
Emerging markets is ticking up a little bit, 10%, but again, still kind of lagging some of the major hitters, so to speak, in the U.S. markets. You can see the VIX up a little bit this year, no big deal. The dollar's up kind of as we would expect. The dollar's been a little bit strong. And then the breakdown across the sectors, which I don't think will surprise anyone too much, but sometimes it's nice just to give a refresher for the audience as to kind of where we sit year to date, broadly speaking, across the sectors. So a little bit of weakness, or I should say notable weakness in healthcare, energy, and real estate. I don't think that's too surprising necessarily given the kind of market that we've had and given the AI story that's been rampant, especially when you parlay that with earnings and the underlying health of certain pockets of the economy. I think where you see some of the strength makes sense. And even diving into, consumer staples up 11%, industrial 16%, utilities 18%. That's kind of your barbell trade that happened across Wall Street, where this year you're having a little bit of that. Okay, we're gonna go into some of the AI and some of the strong earnings, but hey, we're gonna barbell that with a little bit of the risk-off sentiment with your staples, industrials, and utilities, given some of the health in the underlying economy, and just trying to kind of diversify some of those risks. The other story going on in the utilities sector that I'll mention is the nuclear energy that's going on, and there's been a couple names that are benefiting from some of that story, and that's actually a tertiary benefit of AI. Exactly. So that's something that I don't think has been talked about a ton in the markets, is kind of what's going on there, and I think that is a piece of it. Is some of these utilities, once you kind of get down into the nitty gritty of the utility sector, some of the companies are actually benefiting a little bit more from the data center build out and their infrastructure a little bit more and gaining ground. So there's a bit of a rotation into some of those names, which has pushed up the overall sector. So that's kind of what's happening there. It's a bit of a barbell trade. And when I say a barbell trade, I mean when one goes up, the other one goes down. So you're kind of diversifying your risk a little bit. So that's what I mean by that, really, really heavy risk. And so you'll have something less risky. And then when the heavy risk kind of takes profits, your less risky kind of goes back up and protects you a little bit. So that's what that jargon term barbell is meaning. Sorry, I didn't realize I was spouting out the jargon until I caught myself.
No, you're good. Yeah, it's when you look at the sector performance, it's exactly what you would expect in a year like this, with the caveat of utilities. Obviously, that's usually a defensive kind of flight to safety play, but with everyone needing power and energy for AI, right? A lot of those utilities names have benefited from it. So that's really the major outlier. Other than this, it's exactly what I would imagine when, S&P 500's up a little over 20% for the year.
Yep. Yeah, I see a little bit of a broad divergence. I think it's very healthy. Looks good to me. It's actually kind of nice not to see tech leading the charge as much,
right?
Which I think is very healthy. The next piece I have is just a review of S&P earnings growth over the past 10 years, taking a big picture here. This is research from FactSet. It's a little old. It's from the 13th of December, but still relevant when we're looking at such big data sets. The quote is, analysts expect the SPX to report earnings growth of 9.5% and revenue growth of 5.1% for the calendar year of 2024. And then there's a chart that we'll throw up here that shows the dark blue or navy is earnings and the sales growth is the green. And you can see it going back to the calendar year of 2014 and kind of how it's ebbed and flowed. And you can see kind of where we are in 2024, and maybe that helps paint the picture of what's happened over the past 2 years in the markets, and maybe why the market has been so strong. That's maybe helpful for listeners to see.
Yeah, for sure. And I think this is one of the things that the powers that be, so to speak, making the decisions on interest rate policy in this country and the underlying economy, looking at the underlying economy and seeing if it's strong. This is another reason why I think the Fed may not be lowering rates as much as some people thought next year. I mean, they're growing earnings at 9.5%. That's pretty dang strong.
Mm-hmm.
So yeah, looking at this chart, it's great. You can see, the outlier years, both to the negative and to the positive specifically, and calendar year 2020 and then 2021. I think this is a positive catalyst for the market, and I think the strong performance of stocks up until this point in the year kind of backs up these companies growing their earnings and revenue at this rate. So this is a good chart to visualize it, because we always hear and talk about companies in the S&P 500 continuing to report pretty strong earnings, but it's nice to see the data on a chart for us people that love charts, chart nerds.
Yeah, chart nerds, data nerds. Yep, like we are.
Correct.
You mentioned a little bit about the Fed, which is great. That takes me to my last piece here, which is on the Fed's dot plot. This is research from Mohammed El-Arian, actually yesterday. He is, I might mess this up.
He's at Allianz?
He was. He's now at, he's like the head of the economics department at Queensbridge or some college in New York, but he's a really famous economist, and he's on Bloomberg all the time he's like has a special column that he writes at Bloomberg. So
Matt's shared his stuff several times.
Yes, super sharp guy, and really knows his stuff on the economy, of course. He says the following: as shown in the Federal Reserve's latest dot plot, there is a notable dispersion in views among Fed officials regarding how the policy rate will evolve from here. This is part of a bigger problem, namely the consistent absence of a strategic anchoring for policy formulation. As argued in Monday's column, and he references an article that he wrote for Bloomberg, which we'll supply in the show notes if anyone wants to take a deeper dive. So as he argued in Monday's column, this problem will play out in an even more meaningful way during the first half of 2025. And then there's a chart that we'll show here. The dot plot is kind of a silly chart. I mean, there's lots of arguments that some people think we should do away with the dot plot. I'm kind of indifferent. I understand why people like it. I understand why people don't like it.
Can you talk through the chart a little bit for people maybe that are just listening, or just explain for people that will pull this up on YouTube what they're kind of looking at here?
Yeah, exactly. So the dot plot is basically just taking a poll of all of the voting FOMC members where they voted, and it's anonymous, so you don't know which dot is which Fed president, but it just shows you their expectations all graphed out. And so that's very simplistically what it is. It's very simple.
Where they think interest rates are going to be.
Where they think interest rates are going to be.
24, 25, 26, 27, and 28 in this graph specifically.
Yeah. Each individual member has a dot. And so the dispersion element, you can kind of see what Mohammed's talking about here, where it's like very clumped, and then it really disperses once you get down into 2027, 2028. And what that is basically showing is what you alluded to in the news section earlier on this podcast, which is the Fed's comments yesterday and the Fed in general. This dot plot opens the door for ambiguity for the markets of how quick are they going to cut? What does it look like? The market, and that's why you had such the pullback yesterday, I think, is the ambiguity. And, you see this in the dot plot a little bit. And that's what Mohammed is saying here, is just, you want to see the Fed's narrative a little clearer than you're seeing it right here. Because it's a big deal if they only cut, 2 times or 6 times is you're going to change your portfolio. So that's what's going on here. And I just thought this chart might help listeners understand that ambiguity a little bit more and the change in the market yesterday.
Yeah, and I think it's maybe one of the things was it was a little concerning for the market about that there was, like you talked about, that there wasn't as much consensus as there usually is for 2025, and then especially 2026 and 2027. But for next year, there's ranges all the way from 3.25% to 4.25%, and that might not sound like a lot, but it is when we're talking about Fed funds target rate. And then as you continue to go out to 2026 and 2027, there's one member specifically that thinks rates are going to be at like 2.25%, and then there's people that think that it's going to be almost 4%, which is an even wider dispersion. So it sounds like there's a little bit of disagreement among the voting Fed members. And obviously this can this can change. And there's talk right now, obviously, about Trump not being a huge Jerome Powell fan. So we'll see if there's turnover at the head of the Federal Reserve, which could force some other Fed governors to step down or get replaced. So this can always change. But really interesting to see the votes of people that are in charge of making these important policy decisions for the U.S.
What do you think? Should they do away with the dot plot?
I'm gonna take the other side of you. Maybe you didn't say you totally agree that it should continue.
I'm kind of different. Yeah.
I wouldn't mind it because, again, I think these are all predictions, and it doesn't matter until you actually get down to it. And like I said earlier, it would shock me if now that there were only 2 Fed cuts next year, because typically when you have these types of predictions, it's based on the information that they have now, and we always know that can change, or you could have an economic or geopolitical shock to the system that just totally blows up everyone's prior predictions. So I'm team do away with the dot plot, I guess.
There you have it.
Well, thanks, Nick. I appreciate that. I'm sure that'll be a good discussion for listeners. Last thing, moving on to the financial planning topic of the week. This is surrounding required minimum distributions for inherited IRAs the year that the original account owner died. So obviously, required minimum distributions are a big topic, especially with the new laws that have and rules that have been in place over the past couple of years. But I think it's a little confusing for people that if they have a parent or a grandparent who passed away, for example, and they were in their mid 70s all the way up to their 90s, and if they pass away and they don't take their required minimum distribution for that year, it's up to the beneficiary or the person that inherited that IRA to satisfy that before the end of the year. So there have been some updates to this. So just wanted to make sure listeners were aware of this. So generally, when an individual passes away after reaching their required beginning date, an RMD must be taken from their retirement account. So if the individual did not take their RMD or only took a portion of the RMD before they passed away, the responsibility for taking the RMD falls on the surviving beneficiaries. So this situation presented, significant challenges for some beneficiaries because the deadline to take the decedent's remaining RMD was December 31st of the year the individual passed away. So if someone passed away on December 15th, the beneficiaries would need to quickly establish the inherited IRA in their name, transfer the assets into their account, and then satisfy the remaining RMD to avoid that missed RMD penalty of 25%. And number one, if you're dealing with someone who's grieving because they just lost their parent or their grandparent or a family member or a close friend, and they need to coordinate these steps if there's 5 beneficiaries, for example, and make sure the RMD gets distributed with 15 days left in the year. It's really hard, right?
Incredibly difficult.
So with good news, on July 18th of this year, the IRS released final regulations that extended the deadline for taking the year of death RMD. So effective immediately, the new deadline to take the year of death RMD is December 31st of the year following the death of the individual. So this provides the beneficiary or beneficiaries ample time to establish the necessary accounts and satisfy the decedent's remaining RMD. So
that's a good change.
It's a great change. It's, because obviously if someone passes away in February, it's a lot easier and have a lot more time until the end of December. But like we're talking about in this example, you have someone that passes away in the middle of December. There's not a whole lot of time. And if you account for the holidays and the market not being open and financial institutions not being open a full 5 days during the week, and you're trying to get this done, it's very, very challenging. So the last thing that I wanted to just discuss really quick, Nick, is RMD ages, because there's been so much change with RMD required minimum distribution ages increasing that I think it's kind of confusing for people. So there's really 4 different RMD ages that have been in place, over the past couple of years. So if you were born on or before June 30th of 1949, your RMD age is 70 and a half, right? But if you were born before July 1st, on July 1st, between 1949 and 1950, your RMD age is 72. If you were born between 1951 and 1959, RMD age is 73. And if you were born in 1960 or later, the RMD age is 75. So quite confusing with the addition of RMD ages.
Awesome.
Over the past couple of years, so it's hard to track, but Jenna will throw this up on the YouTube page. It'll also be in our show notes. So if you're wondering, hey, I was born in 1953, or I was born between 1949 and 1950, what's my RMD age? It used to be 70 and a half, and now it's either 72 or 73. Just helpful to know that. And obviously, if you're working with a financial professional, you can call them up and they'll clarify all of that for you. That's
what we're here for, but they're not making it easier for the average person.
No, they're not. They're not. They're just over the past several years, it's unfortunately got a lot more complex. We've had a lot of good pieces of legislation passed that I think were net positive for retirement account savers, but it does come with some additional complexity.
Yeah, I think it is a good thing. You'd rather see that option kind of go up, but it's a little complex.
Yeah, it's gotten a little out of control in my opinion. But before we sign off, Nick, anything else you want to leave with listeners?
No, I'll just repeat my messages from last week. I hope everyone's enjoying the holiday time and safe travels and enjoy time with family. And
Great. Well, thanks for joining us, Nick. Jenna, are we recording next week, or are we off next week for Christmas? Okay. So we are not going to be recording an episode next week. So we will be back the following week for episode number 282. Happy holidays to everybody. For those who celebrate Christmas, have a very Merry Christmas. I hope next week is spent with family and close friends, and then everyone gets a little time off to have some R&R and recharge the batteries. So thank you, everyone, for tuning in to episode 281 of the Independent Advisors Podcast.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.